Welcome back, traders. Thanks for joining me here today. In this short video, we will proceed further on the multiple Japanese candlestick patterns. The next Japanese candlestick on the list is the Hikaki pattern. Hikaki is a Japanese word that means to catch, trick, or trap. This is a very complex candlestick pattern. As we can see on this board, the Hikaki candlestick patterns can exist in two variations. It can exist as 5 or 6 candlesticks. This is one of the reasons it's regarded as a complex candlestick pattern. As a beginner, our advice is not to utilize this candlestick for trade entries in the market, not until you have properly mastered the art of Japanese candlesticks. As a beginner, first, try to implement this candlestick for an exit strategy in the market. This candlestick can give you a clue when things do not seem to be going as planned in the market. Pattern A on the left-hand side is the 5 candlesticks bullish Hikaki pattern. Pattern B on the left-hand side is the 6 candlesticks bullish Hikaki pattern. Pattern C on the right-hand side is the 5 candlesticks bearish Hikaki pattern. Pattern D on the left-hand side is the 6 candlesticks bearish Hikaki pattern. Now you can see this formation is a complex pattern. Let's discuss pattern A on the left-hand side, which is the 5-stick bullish Hikaki pattern. Here's the formation of the 5 candlesticks bullish Hikaki pattern. The first candlestick is a bullish candlestick, and the second candlestick is bearish. The first and second candlesticks can be tagged as a bearish inside bar. Remember, we learned it's safer to sell a bearish inside bar in a downtrend. The third candlestick confirmed the bearish inside bar pattern. We can see how sellers start selling the bearish inside bar on the third candlestick. The sellers continued downward on the fourth candlestick. We can see how the fifth candlestick suddenly opened and closed above the high of the first bullish candlestick in this formation. As a trader, whenever you figure this type of price action on any selling setup you execute, it's better to close or exit such a selling position before it gets to a larger loss. We can see how this candlestick pattern tricked and trapped sellers. Once you master the exit strategy of this candlestick pattern, then you can proceed to implement it for an entry trading strategy. Now let's study the 6 candlesticks formation of this pattern. As we can see, the first candlestick is a bullish candlestick, and the second candlestick is bearish. The first and second candlesticks can be tagged as a bearish inside bar. The third candlestick gapped low. It opened below the low of the first candlestick of the bearish inside bar and closed above its opening. The fourth candlestick opened as a bearish candlestick and closed below the low of the third bullish candlestick. Traders who sold the bearish inside bar here would think the market is now moving in their direction of anticipation. The fifth candlestick opened as a bearish candlestick, having its opening above the opening of the fourth bearish candlestick. This fifth bearish candlestick gave a signal of irregular price flow in the market. This fifth bearish candlestick should have opened below the closing of this bearish fourth candlestick. This irregular candlestick formation signaled an unorganized selling setup in this market. The sixth bullish candlestick formation here invalidated the bearish sentiment of this market setup. Whenever you figure this type of price formation setup in the market, it's advisable you close your selling position before the accumulation of more loss. Here's the formation of the bullish Hikaki candlestick pattern at the low of this bearish trend. We can see how it tricked and trapped sellers in this market. It's time we study the bearish Hikaki candlestick pattern. Here are the 5 candlestick bearish Hikaki pattern. The first and second candlestick formed a bullish inside bar that is suitable for the continuation of a bullish trend. The third and fourth candlestick tricked buyers to buy for bullish continuation. Suddenly, the fifth candlestick turned bearish, and it invalidated the bullish inside pattern. Buyers were trapped in this setup. Let's proceed to study the 6 candlesticks bearish Hikaki pattern. As we can see, the first candlestick is a bearish candlestick, and the second candlestick is a bullish candlestick. The first and second candlesticks can be tagged as bullish inside bar. The third candlestick gapped high. It opened above the high of the first candlestick of the bullish inside bar and closed below its opening. The fourth candlestick opened as a bullish candlestick and closed above the high of the third bearish candlestick. Traders who bought the bullish inside bar here would think the market is now moving in their direction of anticipation. The fifth candlestick opened as a bullish candlestick, having its opening below the closing of the fourth bullish candlestick. The fifth bullish candlestick gave a signal of irregular price flow in the market. The fifth bullish candlestick should have opened above the closing of this fourth bullish candlestick. This irregular candlestick formation signaled an unorganized buying setup in this market. The sixth bullish candlestick formation here invalidated the bullish sentiment of this market setup. Whenever you figure this type of price formation setup in the market, it's advisable you close your buying position before the accumulation of more loss. Let's see the action of the bearish Hikaki pattern formation in action on the trading chart. Here's the formation of the bearish Hikaki pattern at the high of this bullish rally. We can see how it tricked more buyers to buy the last leg of this bullish move. As a beginner, our advice is not to utilize this candlestick for trade entries in the market, not until you have properly mastered the art of Japanese candlesticks. In the next video, I will practicalize on a live trading account how to implement the Japanese candlestick patterns you have learned in this trading course. This is where you will learn how to set your stop loss, trailing profit, and to know the probability of your take profit target to be hit or not.